Hello, everyone, and welcome back to Uncommon Sensibilities. It's been a minute. I know that I have been absent as of late, and I have some good reason for that. However, it doesn't excuse the fact that I've not been in touch with you for quite some time. But I did want to get to you today with a quick update now that we have entered the fourth calendar quarter of 2019. Just wanted to do a market update, some brief commentary on a few things that I'm watching right now, and give you a pseudo forecast, I guess, as to what I would expect as we look at the end of the year, which is nearing in sight. This is the end of 2019. We're going to cross into a new decade, and that new decade is going to kick off with what will surely be an interesting election cycle. With all that being said, though, let's talk a little bit about where we've been since really the beginning of August. That was the last time that I touched base, and at that time we had seen the Fed cut interest rates for the first time in the recent cycle. Since August, there have been a few things that I've seen. Really what we've started to watch occur in the markets is there's been a movement away from some of the more specific, either sector-based investments, the types of investments that have a little bit more kind of targeted approach, be it funds that are looking at, like I said, given sectors, market segments, the specifics. What we've seen instead is we've seen a return to the broad indices, the investments that are going to offer broad exposure to the general markets, primarily large cap markets. We've not seen a lot of activity in the mid and small cap. They had been declining in strength really in the middle of 2018 going forward. And the main reason behind that is that those types of investments are, by virtue of their size, their overall inherent risks that they are faced with on a regular basis, they're going to be more volatile. Whereas the very large, let's say, whales, which are represented in things like the S&P 500, especially in the Dow Jones, those kinds of stocks, they have a natural layer of insulation due to their size. They don't really move fast in one direction or another, barring major events. Let's call them black swan events. It's a bit of an overused term these days, but it would be something really radical, like we saw with GE in 2015 through 2018, that would cause something very large to move drastically very fast. But as a whole, the large cap space has been pretty well insulated, and I'll talk a little about that in just a second. But before I do, one of the other really interesting segments of the market that I've been watching closely, especially as it relates to that Fed decision to cut rates, is we've been watching the fixed income markets exhibit some pretty interesting characteristics, some things that aren't necessarily unheard of, but they're unique in the given landscape that we've experienced with fixed income since really the recession of 2007, 8, and 9. I've gotten a kick out of recently seeing a video resurface from a 60 Minutes interview with Ben Bernanke, who at the time was the chair of the Fed in the Great Recession of 2008 and 9. The reason that it's resurfaced is he specifically details the fact that the quantitative easing program, which is effectively the Fed's printing of money and the Fed's easing of monetary policy to, let's say, stimulate the financial markets, by design, is not something that should be into perpetuity. This is something that should have been a very temporary plan if it had existed at all. There are plenty of arguments that can be made that it shouldn't have even been the course of action taken by the Fed, but it did occur. It did happen. The real question that we're now faced with is we started to reverse out of that eased trend. We saw rates increasing. We saw the Fed begin to tighten monetary policy. And while a lot of the underlying economic data remains fairly strong, there's been this let's try and get out in front of what could potentially be coming attitude out of the Fed. and that has led them to begin taking some more easy monetary policy measures, or making decisions that would ease the monetary policy, making it cheaper and thereby easier for people to obtain a loan or obtain assets that could then be used for capital expenditures, personal expenditures, spending. We are a spending-based economy. I got a kick out of a recent tweet that I saw that said we've really got a societal mental disorder where we believe that the strength of an economy is measured by our ability to spend money we don't have. I think that that's a prescient observation of really where we are economically now. There's a lot more to it, but on the surface, that really does say a lot about where we are economically. But to kind of parlay back into the discussion about the fixed income space and why it's so interesting, you've started to see a resurgence of strength in the long-term bond marketplace, both the corporate and the government-issued side. Why is that relevant? Well, effectively what that is saying when you're seeing people flood into those spaces is, in theory, there is a better rate of return for locking money up and losing the purchasing power or investment power of that same dollar. The rate of return or the yield on that long-term investment is better than what they could get elsewhere. I don't know that that's necessarily going to prove to be absolute and true over the time frame. Rarely is it. But that is a signal that can be taken from the markets, which translates into the markets telling us perhaps there's going to be slower growth in equity markets. Perhaps there's going to be even some turbulence, recession, those types of things that you're surely hearing plenty about right now. And the longer term investments in the fixed income market that have a little bit of a higher yield because rates had been going up, and then we see the rate cut. That rate cut occurs again back in August. And here we are now with lower rates going forward. Lock in those higher rates on those investments from yesterday that were issued. And you're willing to give up whatever potential investment opportunities might exist over the term of those longer term bonds. 5-year, 7-year, 10-year, all the way out into the 20-year space. But again, when you get that far down the line, 20 years ago from now would put us on the brink of starting to get really excited about the world ending because the millennium. So you can think of it that way, in the sense of a lot can happen in 20 years. But on that 5 and 7 year time frame, that really is something that can be looked to as a viable signal. So there's a lot of other kind of more technical things happening in fixed income, but what I will suggest to you here and now is don't necessarily be teased into chasing the trend, be it a short term. It may evolve into a longer term trend, but the trend of going longer in duration, or what would be the time scratch duration as a technical term, but just the length of maturity on investments in the fixed income or the bond marketplace. The longer out you go, you inherently do take on more risk. And I think that right now what we're actually seeing is a hyper-reactionary flood to something that really doesn't necessarily warrant the investment. I personally do not believe, and the data supports right now my belief, that we don't have a justifiable return to the amount of risk that has to be taken by engaging in those types of investments. Let's kind of back away from the markets and let's just talk general economy for a minute here. When we look at the economy as a whole, here in the next few days, and by the time I get this video out, we might actually already have received the formal announcement from the U.S. government. But we would expect right now that, barring something significant as a surprise in the inventories, the gross domestic product calculations for the quarter are probably going to come in with growth somewhere to the tune of 1.8%. Now, that will be quickly touted by all the pundits and all the noisemakers and the saber rattlers and everybody else as it's a surefire sign that in fact the economy is getting worse, growth is slowing. That will have kind of capitalized on the past two quarterly reports coming in as slower rates of growth. Here's another case, though, that I want to encourage you: don't be fooled into following the short-term trend. This year has been an interesting one, to say the least. What can't be measured in such a short amount of time, though, is the overall dynamics at play in our global position versus the other larger competitive economies that we would be benchmarked against. Now, yes, is our rate of growth slowing? Sure, it is. What's not slowing, though, and what continues not to slow at this point in time, jobs. We do not see the decline or the loss of jobs. We might see a decline in the rate of growth of new hires, but you have to recognize that, unfortunately, due to the nature of humans, there are a certain subset of Americans who just simply won't work. And they'll say they want to, so they're going to be calculated into the unemployment rate. But saying you want to and actually wanting to work are two very different things. So we're going to reach a point where what we would call peak employment. Now, I think that term right now is being tossed around a lot. I think that it's a term that is much more of a guess than it is factual science. You're using historical data. You're not accurately calculating for things like the gig economy and these types of employments that are unique versus the traditional 9-to-5 wage-based or salary-based job. It's a bit of a little bit of a different animal that we have because of the types of disruptions, but it's not so different that we need to completely scrap all the measurements and the methods by which we try to, peer into what this economy is doing. But when we look at jobs, the jobs numbers are just simply not showing yet that we've got a bigger issue to worry about. Productivity is another case of something that I feel is currently improperly measured. And for that reason, it doesn't necessarily directly play into GDP, but I do think it's something that economists are going to continue to use as a bullhorn, indicating, the weakening economy. I will say it now. I've said this time and time again, and I will always say this. Markets, stock market, bond market, commodities market, investment markets in general do not care whether things are good or bad. They care whether things are getting better or getting worse. So if we start to get all this news that things are getting worse, GDP growth is declining, it's still growing. Don't miss that. Don't miss that important point. It's still growing, but it is declining. Things are getting worse in a very short perspective, but that is not accounting for some of the potential tailwinds that we do have as we go into the end of the year. So I wouldn't be making any rash or knee-jerk reactions right now. The fourth quarter of the year, while last year presented a remarkably unusual challenge in terms of where the markets went as we went from October into the end of the year. Bear in mind, again, last year we did have a very nasty midterm election right around the same time. Uncertainty was supreme, and the real crown jewel in that uncertainty crown was the fact that we saw a shift in leadership in the House. And because of that uncertainty as far as what types of pro-business, generally speaking, smaller government, I got to be really careful using that term, especially when we're talking about Trump, but those Trump agenda items that had been, let's say, constructive for stocks or for companies at large, they were thrown into the questions. They were rather thrown into the pit of uncertainty with that election. And I really think that was a catalyst that started the decline that ended up leading into what we saw in December, which was a very tough sell-off, really kind of capitulating or hitting its peak bottom point, its trough, right there on the Christmas Eve trading day. But kind of to go back, looking at GDP, it will likely be a slower rate of growth than last quarter. So that is going to be a decline. It's going to be touted as a bad thing. Don't worry so much about that right now. Really don't let that news wave that's coming rattle you. What's really interesting, as of actually today, a headline just broke as one of the Democratic presidential candidates, a younger gentleman, a gentleman who has a entrepreneurial background, granted very progressive in his campaign platform, but he came out with a fairly, I don't know, it's an attention grabber to say the least. But he said that GDP is an inappropriate method for measuring the health and wealth of the economy. His argument is that it doesn't account for the human aspects of an economy's health. It doesn't account for the mental well-being, the overall psychological state of the employed population and the working population or the productive population. A little touchy-feely. At the end of the day, economics is not about feelings, and economists don't have feelings, and that's probably because more often than not they're wrong, so they really shouldn't or can't have feelings. But truth be told, while the rationale behind it I would disagree with, the idea that we use GDP as such a dominant metric is much more a matter of ease, or there's really nothing better. Now, there are better ways to look at the health of an economy and to look at the stability in terms of a projected stability of an economy. However, they are not calculated quickly, easily, and the amount of accuracy is not something that you can pinpoint to a data point like you can with GDP, or at least you can to some extent. There is a efficiency curve, if you will, in terms of calculating the health, wealth, well-being of an economy, and GDP has become the staple measurement. GDP, though, is a very relative valuation. It does not account for maturity cycles in an economy. And when I say maturity cycles, think loosely generations. Various generations are various sizes. When we look at GDP and we look at the growth and the growth of GDP, it doesn't a factor for the capable group of individuals. Now, on a quarterly basis, sure it does, because that doesn't change a whole lot. But as we look at these longer term trends, you kind of miss the fact that there are generational changes in terms of the leadership of the working population and the successes of that working population. But specifically, there's also changes in the data metrics for that working population. Now, does that affect inventories? Does that affect trade? Does that affect some of these other kind of subset calculations that are embedded into the GDP calculation? No. But again, if the goal is to look at the health of an economy and a country's overall financial, fiscal, productivity, if you're looking at that in terms of the metrics that might be assigned to those various qualities of a country and a country's economy, you're really missing a lot with GDP. So I would agree that I think it is an outdated metric, and I think it's something that we can't take too seriously. As we're looking ahead in terms of just the next 3 to 5 months, I'm not going to get into 2020. I've got a much bigger idea that we really need to dive into deeper, and I'll be putting that out pretty soon here as we come a little bit closer to the end of the year for what to expect with the next calendar year. But as we're looking at the next few months, as we lean into the last quarter of 2019, tailwinds right now, just generally end of the year, is stronger. The consumption machine that is United States does ramp up. It's unquestionable. The retail sector, good example of something that is benefited during this period of time, even if it's on a decline. We're also going to be looking at folks who are going to be going into the end of the year with the mindset that 2020 is going to be this really bad thing. Interestingly enough, I was listening to a podcast this past week, and I heard an advertisement for another new show, which is titled something to the tune of The Worst Year Ever. And all I heard was some millennial, unfortunately my age range guy just whining and moaning and groaning about how bad next year is going to be. Now, I chuckled because at the end of the day, it's only as bad as you want it to be. Yes, economic data might be bad. Now, how much does that actually affect you? Unless you're an economist, or unless you're working for the government, maybe it looks bad for you. But if it's your specific business, is it directly impacting you? No, probably not. It may mean you have to work a little harder. It may mean that you may not have as many customers or as many purchasers or as many opportunities. But these big, large financial issues rarely individually impact each and every one of us. They impact us in various degrees. But don't fall prey to that idea that undoubtedly things are going to be so bad. Fall prey to the idea that things are going to happen however they do, and I just simply need to be prepared to make adjustments as necessary to protect myself from the inherent risks, but also benefit when there is opportunity that others are unable to see. So with that, as we go into the end of the year, a lot of people do have that mindset, unfortunately, that next year is going to be really bad. They are fearful. If they're, let's say, a Trump supporter, they're fearful that in fact, they're not going to get their election win again. Maybe they're not fearful. I don't know. If they're these never Trump, anti-Trump people, they're fearful that Trump might win again because, well, if they look at their landscape of candidates, barring the ones that are dyed in the wool and the ones that'll just follow whichever mouth, says the perfect thing, they're looking at it saying, oh God, this is the alternative. Wow, this isn't looking too good. Regardless, there are these people that are looking that way. So what ends up typically happening is, and this kind of goes into human psychology, people don't cinch their belts as a means of losing weight. People will do one of two things. They'll either have a heart attack because they got so out of shape and the doctor makes them cinch their belt. That can be the equivalent to a surprise recession, or what shouldn't have actually been a surprise, but it turned out to those individuals to be a surprise. They see the recession come and then they go and they sell everything in their portfolio. They go to cash because they can't stand any more losses. And here they are in a really uncomfortable position, and they're not doing things in a healthy way. The other individuals are the ones that will go on a diet first. They might start to lose their weight, and then they'll eventually start to cinch their belts in. Now, those are the kind of people who they know something's coming, but they're not going to make the change today. So these are the ones that I'm talking about with next year. These are the folks that, as they look at next year being so bad, a lot of these people are saying, well, next year's going to be awful, so we might as well go and do X, Y, and Z now. That might be, we might as well get the kids the new car now. We might as well take the family vacation now. We might as well enjoy our Christmas because next year's going to be so bad, or whatever it is. But even though that's a little counterintuitive, that actually has a high likelihood of occurring at the end of this year, and that'll be a surprise stimulus to the economy. So those are what I feel are right now the large two tailwinds that we might use in a profitable or positive manner. Headwinds. Again, just looking at now to the end of the year, uncertainty is the biggest headwind. It's kind of the Dr. Jekyll, Mr. Hyde to that tailwind of next year is going to be the worst thing ever. There are still going to be a few people who say next year is going to be so bad, so I'm going to go ahead and just really tighten things up now. I'm going to stop spending. I'm going to stop going out to eat. I'm going to stop working really hard. Maybe, I don't know. It may just simply be, I'm going to go and, rehab aspects of my business practice instead of seeking out new business, whatever it is. The political realm is really going to be the biggest catalyst for uncertainty. We know that. That is just the way it is. Just accept that. Be okay with that. Be okay with political uncertainty. It's not the end of the world. Political uncertainty in terms of who actually ends up winning very rarely truly impacts each and every one of us. Just the same as economic recessions and those types of things, that they don't directly impact each and every one of us the same way. Therefore, there shouldn't be this total absolute fear shared by all individuals. There needs to be very specific, unique, personal understandings of how these things will work. When it comes to the political landscape, sure, it might not be what you want, but that doesn't mean it's going to actually impact you directly. So that uncertainty, while yes, it is a headwind for the markets, for you, I would encourage you maybe not to let that get so much in your head that it disrupts your way of thinking clearly. Another potential headwind is right now, while consumer confidence is okay. It's not great. It's not terrible. It's okay. We have seen a recent decline in the CEO confidence. Now, I want to put a little asterisk or disclaimer on that. When it comes to CEO confidence, something that is relevant when looking at that as an indication of overall economic well-being, CEOs are not the pulse takers of the markets. Each and every one of their companies has their own unique challenges, and one of the biggest challenges that any CEO is ever going to face is quality employment. When labor markets are tight, which they currently are, tight meaning there are a lot of people needing to hire and not as many people able to take those jobs. There's transitional employment where you're shifting from a existing position to another, but it's not like they can go and create new people to fill these voids. When it gets to that transitional phase where the only way you can hire new people is you've got to get them from somebody else, that's tightening the labor market even more. That actually is a huge headwind for a CEO. That's a big fear for a CEO because they're looking at, unfortunately, the perpetual growth model. They have to always be growing. So if their goal is always be growing, their resource pool is limited, and in order to get anything from that resource pool, it will cost them more. They are going to see that as a big negative. So their optimism is not going to be as high. That's a great thing for the overall economy, though, because that means that we have reached a point now where we are starting to see that compensations, while maybe not surfacing in the economic data, compensations are getting more competitive, more appropriate for the current marketplace. That's a great thing for those who are working. It might mean, yes, that some of the fat needs to be trimmed on the top of these CEOs, P&Ls or whatever it is that they need to do to make sure that they can be competitive and growing. But really, that's where efficiencies of markets become a huge advantage to the economy and each and every one of us as individual participants in the economy. Last of all, though, in terms of the headwinds, sentiment. Plain and simple, it goes hand in hand with that uncertainty or that political uncertainty and everything else. Just sheer sentiment, not CEO sentiment, not consumer sentiment, just the vibe of individuals. To the Democratic presidential candidate who mentioned that GDP is not an appropriate measurement, talking about mental well-being, the happiness factors and these things. While I think that needs to be left out of economics, what I do think needs to be considered is the overall sentiment of a population. I'm not going to get into the political commentary right now because it's just not going to benefit you in the context of a market update. However, the overall sentiment of our population following the election of Donald Trump and leading into that election cycle has been unbelievably negative, and the resilience that the economy has shown does present a disconnect. It says to me, on one hand, the economy is really strong. If people can be this angry at each other here in the country, whether it was stimulated by Russians, whether it was created by, it doesn't matter. The fact is that people are very angry. If the economy can still be as strong as it has been, despite that, that's actually just like a really good sign. That's a really good indication for the economy. I think that's adversity faced and dealt with, and success came from it. On the other hand, though, something that I think is a dangerous, it's a sword or a blade. It's the guillotine. It's hanging over the economy, and that is what breaks sentiment to the point below where it currently is. What is it that's going to be a catalyst where people just say, I can't do it anymore? As a population as a whole, it's going to take something of significance. We've seen plenty of theoretically significant things occur, and they haven't been able to really, send things spiraling down. But resilience of sentiment over time, maybe it's really not even a big deal. Maybe it's just something little, but it's just been going on for so long because so many people have just been protesting and bickering, and the mainstream media is just making sure that you stay as inflamed emotionally as possible because that keeps you watching them. Maybe it's just one more little thing that just snaps. And because of that, things start to go awry. It's not likely, but it is possible. We want to keep our eye on that. Hopefully St. Nick brings a bag full of goodies in the form of economic strength as we roll into the end of the year. But I wouldn't necessarily put all my eggs in that basket. As far as my indicators go, large cap US is the only place in the equity markets I think you should be paying attention. I think you should be focusing your attention for new monies in terms of drip investments, or perhaps an automatic investment by way of a 401k or qualified plan at work. As you're putting new monies into the market, I think it's still okay to be putting them into the market, assuming you've been on kind of a trajectory, but focus only in on the large cap space. It wouldn't necessarily kill you to increase large cap value or dividend paying investments simply because of that uncertainty factor. At least you've got that dividend reliability that, it can go away, but it's not probable, at least in the short term. That would be a good place to focus. If you've still got mid and small caps in your portfolio, they've seen a recent resurgence. As we get closer to the election, there is a chance they could do pretty well simply because they won't be the target or the focus of any of this kind of virulent, nasty rhetoric that's going to be spewed by the Democratic campaign, regardless of who's the face of it. Attacking big business is a staple of the progressive party, the progressive sect of the Democratic Party. And even those who aren't so progressive, they've realized that it seems to sell well with that constituency. So large cap may come under fire. And because of that, the headline news risk is big. Maybe sticking with some of those small and mid cap investments would actually be beneficial if you already own them. I just would not suggest going and putting money to work there. We've not seen enough increase in strength to warrant new money going there. As a matter of fact, as I look at my indicators here, large cap, we would have to see about a 10% decline before I would be saying it's time to sell out of those. So that's a really nice buffer. In the mid-cap space, we still need to see about a 6% growth as a broad index before I'd be comfortable really allocating. And then small cap, It's the fastest moving. It's the most volatile by virtue of its characteristics. But we need to see about a 9%, 8.5%, 9% ascent in that given space of the market as a whole before I would say it's time to start targeting small caps. Developed international has been teetering around 6% in terms of how much strength I would need to see recovered before I'm willing to put money to work there. I'd need to see the EFA index, see approximately 6% growth before I would put money to work there. I still would tell you steer clear of emerging markets. They might occasionally look enticing. Steer clear. It is way too dangerous right now to be putting your money to work there. There's tons of opportunity, don't get me wrong. But if you're an investor who is human and recognizes that volatility affects us, you may not want your money to work there. And then the commodity space as a whole is just one that just does not show anything appealing to me right now. On the fixed income side, as I mentioned, don't fall prey to the longer term shift in leadership for longer term bond investments. Stay short in terms of short term, 3-year max style of duration of maturity. Don't be shy in the municipal space. If you have taxable accounts, I'm actually pretty constructive still on municipals. I think that right now, because we do have a strong economy, municipalities benefit from that. People are able to pay their taxes. Other than that, that's really where I want to leave you. A little bit of anecdotal evidence. This is not scientific. This is not mathematical. Just take it for what you will. I had the privilege of shooting up to good old Walt Disney World last weekend with my little girl. She had been wearing a cast for a few weeks, had a broken foot, and we thought it would be nice just to take a day now that she has that cast off where she could go walk around the park and see her princesses and do all the fun things there. And I will tell you, we went on a Saturday. Yes, it was Columbus Day weekend, but unless you're a government employee, it's Monday. Columbus Day really isn't a big deal. Most of us don't get off work for that holiday or anti-holiday nowadays. But it was Saturday. That place was packed, and I mean packed. And it wasn't just one of the parks. All the parks were packed. Parking lots were full. So these aren't necessarily these long-term vacationers who had this plan years ago and are staying at the hotels or whatever. These parking lots were packed with owned vehicles. These are not rental cars. I take special note to look at these kinds of details when I go places like Disney World. And for a discretionary expense like Disney World is for families, even if you're a pass holder type of thing where it doesn't cost you anything to get in, it's still going to be an $80, $90, $100 day for a family of 4. Just on snacks and water and engagement in the parks alone. These are discretionary expenses, and people are still doing this very comfortably. It's anecdotal, but I'm a big believer in keep your ear on the ground, and you're going to know a lot more about the economy than the data that the economists are spouting about. Look at your community. Do your crane counting. I joke and I say, if you're in a city, go crane counting. How many large cranes are there? Assuming they're not all on hospitals, because that's a disgustingly insulated market right now. Actually, let me check that. Hospitals and colleges. If the cranes are anywhere but hospitals and colleges, that's a good sign. If they're only at hospitals and colleges, give me a call, email me, tweet me something, tell me, because right now I'm not seeing that here. But that would be a way that I would say anecdotally you can look and see the strength of your market. Thanks so much for your time. I will look forward to being in touch with you soon, and I promise I will have China Part 3 coming up. The riots in Hong Kong have required that I take some time to digest what's happening. A lot of my beliefs are proving to be somewhat true about that. So I'll be with you on that note soon. And until then, take a deep breath, relax, rely on your uncommon sense. It may not be shared widely, but it still exists. And I look forward to talking to you soon. Have a great one.